Well, the Israel-Iran conflict, again, is the latest in a series of volatile episodes that have rattled global markets. Brent crude prices surged by as much as 13%, which is the sharpest daily jump since Russia's invasion of Ukraine. Now, Israel called the attack a preemptive move, warning of a prolonged campaign. Iran, OPEC's third largest oil producer, pumps 3 million barrels per day. That is accounting for 3% of global supply. The shock has revived fears of another energy inflation wave, with traders now bracing for wider supply disruptions. Now, the real flashpoint lies in the Strait of Hormuz, a narrow maritime checkpoint where 20 to 25% of world's oil and much of Qatar's LNG pass through. Any disruption there can push prices far higher. The IMF estimates that a 10% rise in oil prices lifts global inflation by 0.4 percentage points and drags GDP growth down by 0.15 points. That is, heating and electricity costs can also climb, feeding inflation globally and adding pressure on central banks to reconsider rate cut plans. For economies like India, which import over 80% of its crude oil requirements, the impact is swift and significant, from higher import costs to currency fluctuations and inflationary pressure. India's macroeconomic fundamentals are tightly linked to oil. A weaker rupee and higher crude prices directly raise fuel, transport, and manufacturing costs, feeding into inflation. A wider current account deficit also weighs on foreign investment sentiment. If the situation in the Strait of Hormuz worsens, India faces the twin challenge of managing inflation and maintaining external stability. Now, the fiscal and monetary response will be key to containing the ripple effects across the broader economy.